It's another edition of the Trading Tips video newsletter, teaching you how to become a successful trader in less than 5 minutes per week. The video newsletter is brought to you by TradingTips.com.
Welcome to this TradingTips.com video newsletter on moving average envelopes. In this episode, we'll learn what moving average envelopes are, how they're calculated, and how they can be used to determine a stock's trend, and more. Without further ado, let's begin. A moving average envelope uses a simple or exponential moving average as its base, and then applies upper and lower bands based on a set percentage, creating envelopes. These envelopes can then be used to indicate trend and, in certain situations, whether a stock is overbought or oversold. In the example on this slide, we are seeing an IBM stock chart with a 20-day simple moving average as its base, with the upper band set at 2.5% above the moving average, and the lower band set at 2.5% below the moving average. The calculation for moving average envelopes is very simple, but first you have to determine whether you're going to use simple or exponential moving averages, how many days you want to use in your moving averages, and finally the width of the envelopes you'll be using. When considering whether to use simple moving averages or exponential moving averages, one must weigh the comparative pros and cons of the two methods. This was dealt with in a previous TradingTips.com episode number 22. The principal difference between the two methods is that exponential moving averages give greater weight to the recent prices, while simple moving averages give equal weight to all prices within the moving average period. Thus, exponential moving averages are sometimes preferred for use with particularly volatile stocks or in shorter-term trading. Secondly, how long should your base moving averages be? This really depends on whether you're plotting a trade or an investment. The shorter term your view, the shorter your moving averages should be. Finally, the trickiest of the three questions. How wide should your envelopes be? For the answer, let's skip to the next slide. Bollinger Bands and Keltner channels each have automatic offsets for the volatility of a stock, but moving average envelopes do not. This makes using them a little trickier. Bollinger Bands use standard deviation to set channel width, and Keltner channels use average true range. But you have to select your own channel width with moving average envelopes, and the best way to do this is by using some historical backtesting. In this example, we've laid out 2.5% envelopes, 5% envelopes, and 10% envelopes for the S&P 500. The S&P's price movement, symbolized by the black line, never touched the 10% envelopes, demonstrating that they were too wide. It repeatedly touched the 2.5% envelopes, which gave false signals, demonstrating that they were too tight. But when it touched the 5% envelopes, there was the significance we were looking for. Going forward, 5% envelopes would seem to be the best bet. But the best bet for what? Number one, in determining future trends. When a stock breaks through one of its moving average envelopes, it typically signals the start of a new trend. If, for example, a stock breaks out to the upside, going higher than its upper envelope, this normally means that the stock is establishing a new trading range. Even if there is a pullback shortly thereafter, its general trend should continue higher. Conversely, if a stock falls below its lower moving average envelope, it normally means that it will be trading lower in the future. Both of these assumptions presume that the stock is trending at all. In flat markets or with flat stocks, temporary piercings of moving average envelopes can indicate a stock is overbought or oversold. A flat trading stock that exceeds its upper envelope would probably be due for a correction, and a flat trading stock that fell below its bottom envelope would likely be due for a rebound. You can add moving average envelopes to your StockCharts.com stock charts by copying and modifying the instructions listed on this slide in the Overlay section. Note that for simple moving averages, the overlay is called MA envelopes, and for exponential moving averages, it's called EMA envelopes. You would not normally use both MA and EMA envelopes on the same chart, but both are shown here for clarity. Also note that the actual moving averages will not display unless you also select simple moving average or exponential moving average, whichever matches your envelope. If you don't add this, you will only see the envelopes and not the moving average itself. In parameters, be sure to select the number of days followed by a comma and the percentage offset. In conclusion, moving average envelopes are simple but effective indicators that can help you determine a stock's trend, as well as its place in the overbought-oversold continuum. The trick is setting your parameters: EMA versus SMA, the number of days in the moving average, and especially the bandwidth. And the only way to do this is by trial and error. However, a little experimentation and backtesting can produce a reliable indicator that can mean the difference between a profitable trade and an unprofitable trade. Good luck! We hope you've enjoyed this TradingTips.com video newsletter. Thanks for watching and good trading.
This Trading Tips video newsletter has been brought to you by Manny Backus's First Hour Trading System. Every day there's money to be made in the first hour of stock trading. This is the world of day trading, not for novices, unless you have a system, the First Hour Trading System. Visit firsthourtrading.com now and sign up for a free 30-day trial. You could make enough in the first hour of your day to take the rest of the day off. Do you want to view more Trading Tips videos? Visit tradingtips.com. Sign up for our free video newsletters. Become a successful trader by visiting tradingtips.com.